Chemical manufacturer PI Industries has reported a strong quarter with a growth steered by a healthy show in the export segment. In our Ideas for Profit today, I will discuss what has really aided the performance in Q4 FY20 and what should be investor strategy on this stock now. Well, PI Industries manufactures agrochemicals, plant nutrients, plant protection chemicals, also specialty fertilizers and hybrid seeds. Now, the company also provides services in areas including contract research, process development, etc. Now, the company has reported a 6.3% year-on-year uptick in the revenue, largely on the back of a strong show in the exports market and the ISAGRO consolidation as well. Now, the domestic performance, however, saw some impact due to the coronavirus-related disruptions during the lockdown. Exports did see a 12% year-on-year uptick this time. Now, the quarter also saw an increase in the raw material prices. However, with cost controls, EBITDA margins largely remained flat. The position is now stable on the raw material prices front. The company has a strong balance sheet with a debt to equity ratio of 0.2 times. The increase in debt in FY20 was majorly due to planned capex during the year, and low debt and low fixed charge is a positive in the current volatile scenario. Also, the company has a lineup of 5 new products in the current year. Now, the company currently has a strong order book of $1.5 billion US. Now, the company also completed the acquisition of ISAGRO in FY20, and the operational consolidation is expected to complete by the end of FY21. Now, the acquisition is expected to definitely augment the company's domestic business. Margins, however, are largely likely to remain quite flat because of the acquisition. The contraction in net profit was actually majorly due to the higher depreciation as new plants also got commissioned this time. Now, the company had a scheduled fund raising plan via QIP in Q4. However, due to the current turmoil, the same was actually postponed and will actually be taken up in the coming months, say for example. Also, the money raised in planned, whichever is planned through this QIP will be invested to scale up the existing operations and also enable organic growth, R&D, and also for diversification into the new verticals. Now, the company is strategically expanding in the pharmaceutical intermediate space as well. The management also highlighted that they have successfully tied up with pharma companies in India and in Japan, and also supplies are expected to start in Q1 FY21 itself. Now, they have also developed advanced intermediate for promising COVID-19 drug. Now, the company's domestic business is now normalizing, and the demand is also expected to be strong given the healthy monsoon expectation from here on. Now, post a steep correction already that has been witnessed in the month of March, the stock has actually had a steady run and is now fast approaching its 52-week high levels. Now, the current price values the company at 32 times FY22 earnings, which seems to be a tad on the higher side. The company's growth story does remain intact, and the business model is relatively better positioned than the peers to actually overcome the challenges posed by the current turmoil. Now, given a healthy business, we actually would advise all the investors to keep the company on their radar and also accumulate only on correction.